Hello, my audit friends. Welcome back to Let's Talk Audit and Assurance. And right now, I have a fresh set of 100 questions for you in our MCQ Marathon playlist. Now, I know 100 questions sounds a lot. So, as per usual, we're going to divide this into 25 questions designed to help you recall the concepts of auditing theory. So, join me in our first 25 questions as we crack the audit code with questions for board exam preparation. This is a fresh round of our MCQ Marathon Part 1. Ladies and gentlemen, these are 25 questions for one goal CPA success. Let's go. Question number one talks about the final discontinuance after the balance sheet date of a subsidiary which suffered a fire 3 days before the year end date is letter A, an event which must be reported to the Securities and Exchange Commission, letter B, a type 1 subsequent event, letter C, an item which is required to be included in the audit report, or letter D, a type 2 subsequent event. And to this we recall the main difference between a type 1 and a type 2 subsequent event is whether the condition existed on or before the balance sheet date. So the fact that this fire happened 3 days before the year-end date or before the balance sheet date definitely makes this one a type 1 subsequent event. And type 1 subsequent events would require an adjustment to the financial statements. So the answer to our first question is bravo. Next, an auditor is testing credit authorization procedures by examining sales invoices for credit approval by the credit department. The procedures will be considered to be working adequately if 96% of all sales invoices either indicate approval or are cash sales. So, what we see or what we are able to get from this information, where we are told that the procedures will be considered to be working adequately if 96% indicate approval, this simply means that the auditor has set a 4% tolerable deviation rate. Okay, so let's keep that in mind. The auditor has set a 4% tolerable deviation rate. Now, the auditor selects a random sample of 100 invoices. In this situation, which of the following outcomes illustrates underassessment? So let us first try to capture what underassessment means. So when we say underassessment, this means that the auditor has assessed control risk too low because we're talking about underassessment. So the assessment is too low. And because the assessment is too low, that means that the auditor decided to rely on the unreliable controls. Right? So now let's put that or let's keep that in mind. When we say that the auditor decided to rely, that means that the results of the sampling showed that the controls are reliable. But the truth is, had the auditor tested the entire population, the auditor would have seen that the controls actually weren't reliable. So in this case, when we look for underassessment or assessing control risk too low, we look for the scenario with the auditor where the auditor decided to rely on the controls. And when we evaluate the four choices, alpha and delta are the only two choices that indicate reliance, as it specifically says that the auditor finds no deviations and concludes that the procedures work adequately. That means the auditor relied on the controls. This would then mean that we are only going to further evaluate alpha and delta. We could already strike out Bravo and Charlie because Bravo and Charlie did not rely on the controls anyway. So, letter A would say that the true population deviation rate is 5%, whereas letter D would say that the true population deviation rate is 2%. Remember what we pointed out a while back? That the auditor has actually set a tolerable deviation rate of 4%. That means that if the true population deviation rate exceeds the 4%, then the controls are actually not reliable. So, taking that into consideration, this would then mean that the illustration of underassessment comes under choice A. The auditor finds no deviations. The auditor thought, because of the sample, the auditor thought that the controls are reliable. But the truth is, the population deviation rate has already exceeded what the auditor is willing to tolerate. And so, therefore, had the auditor tested the entire population, the auditor would have seen that the controls are not reliable. So, that is why the illustration of underassessment is found in choice letter A. Let's move on to the next question. Which of the following matters is an auditor required to communicate to an entity's audit committee? Number one, disagreements with management about matters significant to the entity's financial statements that have been satisfactorily resolved. Or number two, initial selection of significant accounting policies in emerging areas that lack authoritative guidance. Number three, significant audit adjustments recorded by the entity. And number four, management's consultation with other accountants about significant accounting matters. Now, actually, to this question, the answer is all of the statements. Yes, including those significant matters or disagreements with management that have already been satisfactorily resolved by the fact that these disagreements are about matters significant to the financial statements, then it must still be recorded or reported rather to the entity's audit committee. So all of these, one, two, three, and 4, must be communicated to the audit committee. Let's move on to the next question. The major reason that the difference and ratio estimation methods would be expected to produce audit efficiency is that and let's very quickly recall what is difference and ratio estimation. These are actually estimation or projection techniques that we use in audit sampling. Now, when we talk about ratio estimation, we normally use this one if the misstatement is seen to be more related to the book values rather than to the individual units, whereas difference estimation is a projection technique that we normally use when the misstatements are more linked towards the units rather than the book values. So, why is it expected to produce audit efficiency? Letter A, the calculations required in using difference or ratio estimation are less arduous or less tiresome and fewer than those required when using direct estimation. And that is not true. Okay, when you talk about the calculations, it is not actually more tiresome when you perform difference or ratio estimation. There are no complex computations for this one. Letter B, beta risk may be completely ignored. Beta risk is our type 2 risk, and our type 2 risk is that which affects effectiveness, which is actually very relevant and important to the auditor. So it is not going to be completely ignored. That makes letter B a false choice as well. Letter C, the number of members of the population's differences or ratios is smaller than the number of members of the population of book values. Okay, we're going to think about that. Or letter D, the variability of the population of differences or ratios is less than that of the population of book values or audited values. So we do get to acknowledge that when we perform sampling, then we do perform this one on a sample which is lesser than the population. And so therefore, the answer to this one is letter D. The variability of the population of differences or ratios in the sample is less than that if had we looked at the entire population. Okay. Normally, we also utilize difference and ratio estimation when we project sampling results performed out of a substantive test of balances. And so, therefore, the answer to this one is delta. Next, an auditor has been asked to report on the balance sheet of clock company, but not on the other basic financial statements. The auditor, however, will be given access to all information underlying the basic financial statements. So even when the auditor is only going to give an opinion on the balance sheet, the auditor is still granted access to all information of all financial statements, not just the balance sheet. So under these circumstances, the auditor, letter A, may accept the engagement because such engagements merely involve limited reporting objectives. Or letter B, should refuse the engagement because there is a client imposed scope limitation. Or letter C, should refuse the engagement because of a departure from generally accepted auditing standards. Or letter D, may accept the engagement but should disclaim an opinion because of an inability to apply the procedures considered necessary. So the question here is there really a scope limitation? And the answer is there is none. Precisely, the auditor has been given access to all information underlying the basic FS. So the question is, can you accept this engagement? The answer is yes. For as long as the auditor is given access to all the information needed, then the auditor may accept the engagement. So the answer to this one is alpha. Next, a new partner in an audit firm is asking for your help. He seems to have trouble differentiating an inspection from a review in the context of engagement performance as part of the elements of quality management. So perhaps you'll be able to recall this one under quality management principles that there is such a thing as an inspection, and usually an inspection cycle would span a period of 3 years. So, what is the difference between an inspection and a review? Let's evaluate the choices. Letter A would say a review is conducted with a view to check for the weaknesses in the firm's quality control procedures and systems, while an inspection is conducted during the audit work with the prime objective of ensuring compliance with auditing standards. And actually, letter A is not a correct statement, because if you wish to look at a review, for example, conducted with a view to check for the weaknesses in the quality control procedures and systems, what is being performed here or what is being invoked here is monitoring and not review. Okay. Letter B would say a review is not required while an inspection is. And letter B is also false because a review is required. It is part of the audit process. It's part of the steps that we perform when we do an audit, and that is, of course, to review the work that has been done. Letter C, a review is similar to a cold file review, while an inspection is a hot file review. So when we talk about a cold file review, that means that the engagement has already been completed. That's why it is cold, and it is being reopened. That would represent or would reflect the presence of an inspection, because when you talk about an inspection, it means that an engagement has been completed. Okay, while I think letter C has actually interchanged the terms. An inspection is similar to a cold file review, while a review is a hot file review. So letter C is not a correct statement. That then leaves us with the final choice, letter D, and this is our correct answer. A review is done while the audit is ongoing, while an inspection is done after the audit report has been signed off. Now let's revisit some concepts for internal controls with this question. What do we call the overall attitude and awareness of an entity's board of directors concerning the importance of internal control? Of course, when we talk about the components of internal control, this is reflected as the tone at the top, and we refer to this as the control environment. So the answer to this is alpha. Next question. The auditor's objective during an observation of a client's physical inventory count is to, letter A, allow the auditor to supervise the conduct of the count so as to obtain assurance that inventory quantities are reasonably accurate. Letter B, obtain direct knowledge that the inventory exists and has been properly counted. Letter C, discover whether a client has counted a particular inventory item or group of items. Or letter D, provide an appraisal of the quality of the merchandise on hand on the day of the physical count. Now, we are to be reminded that when the auditor observes a client's physical inventory count, he does precisely that. He observes. Therefore, the auditor is not actually the one who will supervise the conduct of the count, because that is the count of our client. We are simply there to observe. Now, we are also reminded that the main assertion being tested in the observation of the physical inventory count is the assertion of existence. And so, therefore, the answer to this should be bravo. Obtain direct knowledge that the inventory exists and has been properly counted. So, while it may be possible for you to take a look at the condition of the inventory items, your test counts might also reveal that the client might have missed a certain group, but those are a certain group of items, but those are just offshoots of our observation. That is not the main assertion being tested in this particular audit procedure. The main assertion is, of course, existence. So the answer to this is bravo. Next, an examination of part of an organization's procedures and methods for the purpose of evaluating efficiency and effectiveness is what type of audit? Is it letter A, operational audit, letter B, compliance audit, letter C, production audit, or letter D, financial statement audit? And the answer to this one, of course, when we look at efficiency and effectiveness, is operational audit. So this should be letter A. Next, in an audit of financial statements, due professional care requires letter A, a responsibility to exercise reasonable care, letter B, testing the system of internal control, letter C, the exercise of error free judgment, or letter D, the examination of all corroborating evidence available. Do professional care requires, of course, simply a responsibility to exercise reasonable care. So the answer to this one is alpha. Let us now evaluate this next question. In planning a December 31, 2024 year-end audit, you note that for the 2023 engagement, your firm's assessment of audit risk was high and the preliminary estimate of materiality was 1,200,000. And this was allocated to the balance sheet accounts based on the standard deviation of the recorded transactions within each unaudited account. Now, owing to the design of a new accounting information system and improved control procedures, both of which were supervised by your firm's management consulting division, you judge that, unlike in 2023, the risk in 2024, which is the current year you are auditing, that material errors could occur and not be prevented by internal controls is now well below the maximum. This simply means that for the current year, controls have improved. So, which of the following statements is then true? Letter A, the risk of material misstatement in 2024 is likely to be higher in 2024 than in 2023, but then we do remember that controls have improved this year, right? Or letter B, the 2024 preliminary estimate of materiality will likely be lower. And then we also recall that when we lower the materiality estimate, that actually means we are stricter, right? Because we are more sensitive even for smaller misstatements because we have lowered the materiality. And so, therefore, for letter B, again, we have become stricter, but actually, the controls have become better. Does it seem like an expected response? Or let's take a look at letter C. Compared to 2023, control risk is likely to be lower in 2024 because controls have become better. Or letter D, acceptable detection risk in 2024 is likely to be lower. And we also recall that when we talk about acceptable detection risk, when you lower your acceptable level of detection risk, you have actually become stricter as well. Now, when controls are better, we become more relaxed because the controls are good, the controls are reliable, the controls have improved. And because we have become more relaxed, then we shouldn't go stricter. So the answer to this one is letter C, right? Control risk is likely to be lower in 2024 because the controls have improved. So Bravo and Delta and even Alpha all reflect instances where the auditor would be stricter, which is not how the auditor responds in case there are reliable controls. So let's move on to the next question. Which statement is incorrect regarding the code of ethics for professional accountants in the Philippines? So take note again, we're looking for the incorrect statement. Letter A would say the code of ethics for professional accountants in the Philippines is mandatory for all CPAs, and letter A is true. That is correct. Letter B, professional accountants should consider the ethical requirements as the basic principles which they should follow in performing their work, and letter B is also true. Letter C, professional accountants refer to persons who are certified public accountants and who hold valid certificates issued by the Board of Accountancy is also true. That means Delta must be the incorrect statement. What does Delta say? Where a national statutory requirement is in conflict with a provision of the IFAC code, the IFAC code requirement prevails. This is incorrect because when local laws are in conflict with the code of ethics, the local laws would prevail or that which is more restrictive. Okay, so Delta is the incorrect answer. Next, what is engraved on the upper portion of the space between the circles of a CPA seal? To this, we revisit RA 9298 or the Philippine Accountancy Act of 2004, which prescribes that the seal of the CPA must be circular. And this seal must come with the following elements. There would be a smaller circle and a bigger circle, and on the upper half, between the small and the big circle, shall be engraved the name of the certified public accountant. On the lower half, in between the small and the big circle, shall be engraved the CPA registration number, and in the middle of the small circle shall be engraved the letters CPA. So in this case, the question is, what will we find on the upper portion? The answer will be the name of the individual CPA. So that should be alpha. Next, to emphasize auditor independence from management, many corporations, letter A, establish a policy of discouraging social contact between employees of the corporation and the staff of the independent auditor. Letter A kind of tells us that we shouldn't be friends with our audit clients. Letter B, request that a representative of the independent auditor be on hand at the annual stockholders meeting. Letter C, appoint a partner of the firm conducting the audit to the corporation's audit committee. That means to say the external auditor is now a member of the audit committee. Or letter D, have the independent auditor report to an audit committee of outside members of the board of directors. And I think we're already able to spot our correct answer. The correct answer is Delta. Have the external auditor report to the audit committee, and this audit committee should be comprised of outside members of the board of directors, meaning to say they are non-executive directors. So delta. Next, we go back to the seal of the CPA. This time, what is engraved on the middle portion inside the smaller circle? As we have previously mentioned, we would of course find the letters CPA. So the answer to this is alpha. Next, we are currently completing the audit of Buddy Company for the fiscal year ended June 30, 2024. Now, in the course of your review for subsequent events, you noticed a board of directors minutes of a meeting, and this minutes was dated August 16, 2024, authorizing the write-off, or the minutes included an entry authorizing the write-off of a trade receivable amounting to 1 million. You trace the entry for the write-off in the journal entries and have found it to be in order. Upon further investigation, you learned that the customer became a victim of a Ponzi scheme and has filed for bankruptcy on June 1, 2024. However, the court has approved the declaration of bankruptcy only on August 15. Now, what will you propose to management regarding the aforementioned subsequent event? And to this, we have to firstly identify, is this a type 1 or a type 2 subsequent event? Again, if it is a type 1 subsequent event, the condition existed on balance sheet date. Now, the customer was already actually a victim of a Ponzi scheme and has filed for bankruptcy on June 1, 2024, which already is, or which belongs to the period under audit, meaning to say this transpired even before the balance sheet date. And so this one would definitely qualify for a type 1 subsequent event because as of June 30, this customer has already filed for bankruptcy, even if the final declaration happened afterwards or subsequently. The fact remains that the condition existed on or before the balance sheet date. And so, therefore, because this is a type 1 subsequent event, then we will need to propose an adjusting entry for the year ended June 30, 2024. The subsequent event is a type 1 event, thus, an entry to adjust the June 30, 2024 balances is necessary. And we will find this choice in letter A. So, the answer to this is alpha. Next, evidence of the arrival of fixed asset additions might be found in. So, where will we find evidence that the fixed assets have arrived? Is it in the letter A, cash disbursement journal, letter B, purchase orders, letter C, receiving reports, or letter D, the minutes of meetings? Evidence of the arrival of assets is, of course, documented in our receiving reports because the assets have arrived, the client has received them, and the client will prepare receiving reports. So the answer to this is Charlie. Next, which of the following is not represented in the Auditing and Assurance Standards Council, which is our standard setting council for our auditing standards? So is it letter A, the BIR, letter B, the Board of Accountancy, letter C, the Commission on Audit, or letter D, the Bangko Sentral ng Pilipinas? Before we reveal the answer to this one, let us be reminded that the composition of the AASC currently is now a total of 18. That will be one chairperson plus 17 members. The one organization among these four that is not included there is the Bureau of Internal Revenue, or the BIR. The BIR is not represented in the AASC, and this is the composition of the AASC. You will have one chairperson, and the chairperson must have either been or is currently a senior practitioner in public accountancy. You will have one member coming from the Board of Accountancy, one coming from the Securities and Exchange Commission, one coming from the Bangko Sentral ng Pilipinas, another one from COA, or the Commission on Audit, one more from the Insurance Commission, and one from the Association of CPAs in Active Public Practice, and 11 from the accredited and integrated National Professional Organization, which currently is PICPA. And out of the 11, 9 will come from public practice, 1 will come from commerce and industry, and 1 will come from the academe. So that makes it a total of 18. 17 members plus 1 chairperson. So what we won't find there is BIR. So letter A is the answer. Next, an auditor's report includes a statement that the financial statements do not present fairly the financial position in conformity with generally accepted accounting principles. Now, this auditor's report was probably issued in connection with financial statements that were letter A, restricted for use by management, letter B, misleading, letter C, condensed, or letter D, prepared on a comprehensive basis of accounting other than GAAP. This particular opinion, where the auditor says the financial statements do not present fairly, represents an adverse opinion. An adverse opinion is given by the auditor when the financial statements are misleading. So the answer to this is bravo. Next, which of the following would be the most appropriate audit procedure to test the processing of interbank transfers? So again, we're talking about interbank transfers. Letter A, trace all bank deposits recorded in the accounting records near the end of the fiscal period to supporting documentation and to bank statements. Letter B, analyze a sample of interbank transfers throughout the period, including period end reconciliations. Or letter C, obtain cut-off bank statements for each bank account and reconcile them to accounting records. Or letter D, send bank confirmation requests to each bank in which accounts are maintained and reconcile the completed forms to accounting records. So we once again point out that what we are trying to test are interbank transfers, and the one out of these four choices that directly refers to interbank transfers is letter B. When we analyze a sample of interbank transfers throughout the period, the choices we have for letter A, C, and D may find out eventually about interbank transfers, but it is not directly related to that, as these may also be tests that we perform when we audit the cash account, which may or may not include interbank transfers. So again, Alpha, Charlie, and Delta may be used to test the cash accounts, and this may or may not include interbank transfers, as opposed to letter B, which specifically tests the interbank transfers themselves. So bravo. Next, an advantage of statistical over non-statistical sampling is that statistical sampling, letter A, is compatible with a wider variety of sample selection methods than is non-statistical sampling. Letter B allows auditors to inject their subjective judgment in determining sample size and selection process in order to audit items of greatest value and highest risk. Or letter C enables auditors to objectively measure the reliability of their sample results. Or letter D permits the use of a smaller sample size than would be necessary with non-statistical sampling. To this, we recall that both statistical and non-statistical sampling are acceptable. Both would still make use of auditor judgment, although it would be more in non-statistical, but then still both would use auditor judgment. The main difference between the two is that statistical sampling allows you to quantify the risk. And so, because of that, it also allows the auditor to objectively measure the reliability of the sample results because it allows the auditor to quantify the risk. So, the answer to this is Charlie. Next, when an auditor increases the assessed level of control risk and we stop for a while and we try to imagine what will happen when the auditor increases the assessed level of control risk. This would then mean that the auditor does not rely or does not have any intention to rely on the controls. Okay, because the auditor has increased control risk because certain control activities were determined to be ineffective. So there you have it. The auditor would most likely increase the letter A, extent of test of details, letter B, extent of test of controls, letter C, level of detection risk, or letter D, level of inherent risk. Now, when the auditor does not intend to rely on the controls, the auditor will not test the controls and would perform extensive substantive tests. And of the four items we have here, that which reflects that is letter A. The auditor will increase the extent of test of details. So alpha for this number. Next, the auditor's program for testing long term debt should include steps that require letter A, examining any bond trust indenture agreement, letter B, inspecting the accounts payable subsidiary ledger, letter C, investigating credits to bond interest income, or letter D, verifying the existence of the bond holders. When we test for long term debts, one of our steps would always be to examine any bond trust indenture agreement because in this case we are looking at the actual bonds that were being floated by the client. Okay, and when we talk about long-term debt, then that would result to interest expense and not interest income. Because we're looking at long-term debt, we wouldn't be looking at accounts payable because accounts payable is a current liability, and we don't necessarily verify the existence of the bondholders. So in this case, the answer is alpha. Next, which of the following factors does an auditor generally need to consider in planning a particular audit sample for a control test? Is it letter A, the estimated standard deviation of the population, or letter B, tolerable error, or letter C, the number of items in the population, or letter D, the total dollar amount or peso amount of the items to be sampled? Now, do take note that we are looking at a sample for a control test. And so, therefore, we don't necessarily look at the total dollar amount of the items to be sampled. And we also recall that in the case of sampling, the number of units in the population actually have a negligible effect on our sample size. So we're left with two choices. Is it the estimated standard deviation or is it the tolerable error? And the answer to this one, of course, is tolerable error. And we recall that tolerable error has an inverse relationship to our sample size. Next, when an acquisition is on an FOB origin basis, when we say FOB origin, this is the same as saying FOB shipping point, okay? Because the shipping point is the origin. So when an acquisition is on an FOB origin basis, the inventory and the related accounts payable must be recorded in the current period if the goods were, letter A, received prior to the balance sheet date, letter B, paid for in advance, letter C, shipped before the balance sheet date, or letter D, both shipped and received prior to the balance sheet date. Now, because this is FOB shipping point, the buyer owns the goods while in transit, and we are talking about an acquisition, and so therefore we are the buyer. And so these goods become ours the moment they have been shipped. And so if they have been shipped prior to the balance sheet date, we should already recognize the inventory and the related accounts payable. And 25 questions have gone by so fast, haven't it? Congratulations for finishing our first 25 questions in this fresh round for our MCQ marathon. And once you are ready, join me for part two.